So without further ado, my first part of the session should last about 20 minutes and then we'll pass over to Tim. We do need to put the disclaimer on there that, that this is advice is generic in nature and it doesn't take into account your personal needs and objectives. So obviously for that you need to speak to your advisor. So let's go through. Now, all up there were 16 sort of measures that we summarised, but we would put them in the category of 3 very important measures in the budget, 3 quite important measures, but perhaps less important than the first 3. And then the remainder were ones that we're just going to summarise, but we don't believe they'll result in a whole lot of strategy work coming forward. So first of all, and in relation to this, I guess what we have to assume, it's always challenging to pitch these at the right level, make them not too simple or not too complicated, but we are having to assume that you, through your advisors and through your own sort of experience, you have a little bit of knowledge of super, but perhaps not a lot. So there's a bit of implied knowledge, but certainly if you feel that there's more clarification needed, certainly make sure you follow up with your advisor and highlight what it was that needed further clarification, or even put in the chat. We might have time to deal with it that way. So measure number 1 we'll talk about is the removal of this curious thing called the work test. So for those of you who know super rules, you would know that once you attain the age of 65, there was, in order to be able to contribute to super, you had to work that 40 hours in a consecutive 30-day period in a given financial year to be able to contribute to super. It was always a bizarre sort of test that we felt was difficult to difficult to police, and also quite a grey and curious reason being able to contribute. So I think the government perhaps ultimately has thought the same way and they've decided to scrap it altogether. But what that does is it means that it opens it up. The only criteria now is age-based, and that is that you must be less than 75 years of age plus 28 days. So I've just put in there plus 1 month in order to make contributions. But interestingly, the one type of contribution that was excluded was if you make a personal tax deductible contribution or a personal concessional contribution. But salary sacrifice contributions, non-concessionals are all now exempted from the work test. We expect this to be applicable from 1 July 22. As you can see in the asterisks down the bottom, most of these measures will be effective in the first financial year after they receive royal assent. But we're just sort of suggesting that it might be unlikely we get royal assent before the 30th of June. We could do, so therefore if we did, it would be effective 1st of July 2021. It's more likely going to be 1st of July 2022. Now, importantly, what's the implication for strategy? Well, this could be a really, really important one, because obviously it opens up contributions up to the age of 75, which opens up things like a recontribution strategy, which is how you might recycle money that's taxable or bad for your estate, in terms of non-dependent beneficiaries. It'll open up those strategies again. Importantly, equalisation strategies is where you know that there is $1.6 million that each of us are allowed now to have in our transfer balance cap or in pension mode in super. This might open up the door to be able to take money out of one spouse's account, put it into another to equalise and get somewhere up close to $3.2 million in pension mode. Alternatively, you can, we didn't have this silly thing where you couldn't make contributions in the first week of July because you hadn't passed the 40 hours and 30 days yet, So again, that would get rid of that anomaly. And what is probably as interesting as anything is that to align with this, the bring forward rule, which allows you to put 3 years worth of non-concessionals into one go, which incidentally has now increased from 100 to 110,000. So that would bring the 3 years to 330,000. The government has stated that their intent is to align the bring forward rule with this rule right up to age 75. Current legislation that's still sitting in the Senate had it up until 67. Still hasn't, even that hasn't been passed yet. But what their intention is to actually bring it right up to 75. So if that happened, it would open up essentially an extra 10 years of open slathering contributions, which would be pretty beneficial. Number 2, the Downsizer Rule. Many of you may or may not know what the Downsizer Rule is. It is effectively, it was an exceptional contribution measure in the sense that it was outside the normal contribution rules. So if you sold your principal or property that had a principal place of residence capital gains tax exemption, even a part one, what it enabled you to do was to use a 90-day window to put further contributions into super. Now, you could be at any age, but you had to be at least 65. So what they've done here is, really haven't changed at all. They've just brought it back 5 years for that Downsizer Rule to be applicable from age 60 rather than 65. Where it gets interesting is if you then combine it with rule number 1, it can potentially open up to $1.26 million of contributions upon downsizing your home. And what we mean by that is, for a couple, you could potentially put in 300 each from a downsizer, which is of course not part of the non-concessional caps. Plus now, your 330,000 each if you use the bring forward rules each. So that, as a couple, if you optimize that completely, it could be up to potentially 1.26. And potentially that could be up to 75. So again, it would be a real opportunity to get money in one hit into super. But it really is, those two rules interacting with each other. Number 3, again, really interesting one. We had these relics of pensions that began back prior to 2007 that had Centrelink concessions, and they were called complying pensions. The last of those concessions finished on 20th September 2007, but unfortunately these things were of the nature they were all non-commutable, or irreversible, I like to say. So once you started them in good faith, you made the decision for good. You committed that capital in return for the Centrelink concession. Now, of course, there is no benefit from Centrelink, so there is very little reason to start one of these things, and particularly with interest rates so low as well. So the government's obviously thought, let's provide a 2-year window where we'll give people essentially almost a once-only chance to unwind these if they feel that any benefits they have from them are no longer there. So again, similarly, this will apply the first financial year after royal assent, and of course we expect that to be 1 July 2022 if it's not passed through the Senate before the 1st of July this year. But it will be a 2-year window after that, and you can commute those pensions. If they're in super, you commute them back to accumulation mode, and that will you'll lose any Social Security exemption, but you'll have to assess whether that was something that didn't matter to you anyway. So again, this will mean that that capital will be accessible again. So for some people, that would be very valuable. So I would argue that anyone with these pensions will need to review them within the next couple of years as to whether they stop them or not. Item number 4, self-managed super fund residency relaxation. So what this is there were some pretty tight rules around whether a self-managed super fund was an Australian super fund or not. And if it wasn't a complying Australian super fund or Australian resident super fund, it had to be wound up effectively. Otherwise, you paid somewhere close to 47% tax on the taxable component, which is of course a disaster. So now previously there was, if you had to satisfy a control test. The temporary absence was only for 2 years. So if the minute you go permanently, I think that you've failed the condition, but you're allowed to leave temporarily. But even after 2 years, the fund became non-resident. And they also had this thing called an active member test, which was if you had any accumulation members that were contributing and they added up to 50% of the fund, then the fund was non-resident as well. So really the only way you could keep a fund if you went overseas was to have it in pension mode and of course not be contributing. So what they've done is they've relaxed that. They've said you can now go away for 5 years on a temporary absence, and this active member test we think is is unfair. So we'll get rid of that altogether. So it does open the door for many overseas clients or people who are contemplating going overseas, being able to retain their self-managed fund, which we think is fair and reasonable, unless, of course, they're going permanently, which the government sort of says you shouldn't have one. So the three top measures we think are really important, starting with the SMSF residency. That will apply to some people, but not all, of course. And then we move into just a few simple tax measures. The low and middle income tax offset is one that was due to be scrapped this year, but will continue on. Where we think that affects a lot of our clients is it does have implications in what the effective tax-free threshold will be, which, as we know with superannuation, there are limits on how much you can have in super. And there are certainly minimums that you must take out. So overwhelmingly, a lot of our clients, if you're not spending everything you're taking, they end up building up money in their personal capacity. And so it is important to know how much can you invest in your own name or in joint names before you start to hit the effective tax-free threshold. So again, with the low to middle income tax offset, that's pretty high. So for each member of a senior couple, which is over 65, you can have 30,000 of taxable income, which might include dividends or capital gains or anything from an investment portfolio before you start to pay any tax. So again, that's a good thing to continue. I think on this tax residency stuff, they've also looked to simplify that. There was a permanent residence, a permanent place of abode test, which was a bit subjective. Then there were secondary tests to this, which was the 183-day rule was one of those, and there was a Commonwealth super rule as well. But what they've said is, let's simplify it all together, make it objective, and the primary test will be the 183-day rule. So if you spend 6 months, if you just spend a tick over 6 months in the country, then you'll be an Australian resident and taxed as an Australian resident. So as for the other measures, we've summarised them all here. Again, I'll run through them very quickly, but they may be applicable. We're only just making some assessment that we thought that these may not be as applicable as the others. So the first one is employee share schemes. There was what you normally did was you got taxed at a future point or a deferred tax point. There was 3 of those. The difficult one was cessation of employment, because often you would leave an employer to then be required to pay the tax before any restrictions were lifted on the shares, and you didn't have the money to pay the tax. So they removed that, and it is just now the earlier when restrictions are lifted, or 15 years that you have to pay the deferred tax. The first homeowner super saver scheme, that's what that stands for. Apologies for the acronym. What that is effectively a salary sacrifice scheme to super, which sits in a separate account, and you could pull out up to 30,000 for a deposit on a home for first home buyers. That's now increased to 50,000. So again, just a little bit more scope in recognition of the increase in property prices. For superannuation guarantee, so employers didn't have to pay that if somebody earned less than $450 a month. So that's now been scrapped. So they believe that that's going to help part-time workers and students and women in particular. The pension loan scheme is one which may actually be quite applicable. What that is effectively a reverse mortgage that's run by Centrelink. And so in the past, what Centrelink would say is, if you gave us a mortgage on your home, we'll let you have up, regardless of what your rate of pension is, even if it's $1 of pension, we'll pay you up to 150% of the single age pension rate. But whatever is over and above what you deserve will be considered a extension on your home loan or a reverse mortgage. But you always had to take it as a fortnightly payment. Now they're allowing lump sums, and they've also put in a no negative equity guarantee. So if at any point you live for a long time and you end up owing more to Centrelink than what your home's worth, you won't have to pay the difference. There was a slight increase in Medicare levy thresholds. I'll just let the numbers speak for themselves, but But that's the threshold you get to before you have to pay the Medicare levy. So for seniors, that's 36,705 for a single person and 51,094 for a couple. There's quite a couple of really strong initiatives for business. So the first one is, which has been in existence, but it's this budget, they extended it out to 1st of July 2023, was the ability to write off depreciable assets all in one go in the first year. So an instant asset write-off. Normally you'd have to put them in a depreciation schedule, but what they're saying is for very large businesses with 5 billion turnover or more, we'll let you do write-off brand new assets only. But for anyone who's less than 50 million in turnover, we'll let you write off any assets. So the second one was around losses carried back. Now this is really interesting because tax losses have only ever been able to be carried forward to offset future tax returns. But they've in order to inject more money into the economy and business community, what they've said is, look, if you made a loss in any of the years starting in 2019 up to 2022, it will allow you to go back and amend past tax returns in order to get some of that tax that you've paid back. So this is applicable all the way up to 2023, and again, it's almost like an averaging provision over a 5-year period. For allowances, now this is specifically due to some of the pressure on increasing the rate of job seeker, which is the old New Start allowance. All allowances rate increases were up by $50 a fortnight. Income thresholds were increased, so you could earn it, so people could earn a little bit more income before it reduced their payment. But in return for that, there is an increased activity test. So they now have to search for 20 jobs a month rather than going forward. So childcare, again, childcare subsidy has increased by 30% for the second and subsequent child. The annual childcare cap, which used to be $10,560 per child, has now been removed. So that cap's unlimited, but there is hourly fee caps that remain. So basically, it's opened to pretty much all children, and there's effectively, it's designed to sort of not put an upper limit on it, so that people can work as much as they like. And finally, there was probably one of the biggest spending measures in the budget was about 17.7 billion in aged care funding over the coming 5 years. So the current total spend in aged care is about 23 billion. So it was almost a doubling of the total aged care spend. This is post-Royal Commission, where they've accepted something like 126 of the 144 recommendations through that Royal Commission. There'll be increased government subsidies of $10 a day for every resident, but with actually no change to the consumer calculations of funding. So the resident won't notice any increase in their contribution to the fees, but the government will provide an additional $10 a day subsidy to the facility. There'll be 80,000 new home care packages released over the next 10 years, which brings the total number up to 275,000. It's worth noting that just 2 years ago, the total number of home care packages was about 116,000. So a substantial increase in just 2 years, more than double in terms of how many home care packages now available. And there'll be some simplification. So there'll be a merger of the Commonwealth Home Support Program with the home care system, and also a one point of assessment. So you're not getting assessed by different people, and also improve governance and auditing in the aged care system. Okay, so Tim, so that's all from me, but what I will obviously I went through that pretty quickly, but obviously we'll be available for questions at the end. So what I might do now is I'll stop sharing my screen and pass over to Tim for his.
Thanks, Graeme. What I'm going to do today is take you through these 5 themes, which are the ones that are making the biggest impact on the way your portfolio is put together. And basically, the first one is this recession we've been through. We think it's going to have very minor impact on long-term returns, lots of impacts on society, but in terms of the returns out of your portfolio, not too much. The second theme that's driving the portfolios is the idea that interest rates are going to stay very low for decades, which obviously has got big implications for all parts of your portfolio. We think that shares and commercial property will give us higher returns than cash and TDs and government bonds even over the next decade, which, given we think they're going to stay very low, is not really a big ask. The one exception is US equities, where we're expecting to see quite low returns. And the final point is this idea that credit, in other words, loans or investments in fixed interests that are not effectively government guaranteed, are pretty good value compared to equities. So that's where we'll be going. Along the way, I work very hard not to use too much jargon, but I'm not very good at it. If I fall into using jargon, please use the chat room to say, what on earth does that mean? And we'll try and address it as we go through. Any questions you have as we go through, once again in the chat room, and if we can pick those up, we'll try and deal with them along the way. Otherwise, at the end. So this first idea that the COVID recession is unlikely to have major long-term impact on returns is one piece, but it will have big impact on obviously society, but there's some quite strong economic impacts that don't necessarily translate into investment returns, but are still important. And the really big one has been governments, not just here, which we saw in the budget, but everywhere, are far more comfortable with the idea that they're going to run huge budget deficits in the time of a crisis or a downturn. Up until now, the job of picking up an economy that was struggling or in recession, or slowing down an economy that was running too fast, has been overwhelmingly with the Reserve Bank or the Fed in the United States, central banks everywhere. And the idea is, if the economy is running too fast and there's a risk of inflation, they lift interest rates. That's meant to slow the economy down. And similarly, if the economy is slipping into recession or just going too slowly, unemployment's creeping up, the idea is they reduce interest rates to encourage investment and inject a little bit of extra money into the economy to speed things up. But obviously, with interest rates so low, that impact of reducing rates is now very limited. Up until really the last year or two, most governments around the world have been really reluctant to use spending as a tool to help regulate the economy. That's really changed now. And one of the major concerns in the market is, will that lead to recession? Will that lead to high inflation, and what are going to be the impact? We think it's actually reasonably modest, but in terms of returns, we think what we've seen so far won't have much of an impact. What we've seen so far in terms of COVID won't have much of an impact on long-term returns. So we go to the second point, which is this idea that interest rates are going to stay low for decades. And here, it's worthwhile distinguishing between cash rates and bond rates. Now, the orange line here are cash rates, which are set by the RBA. As I mentioned before, they do that with the idea that if the economy is going slowly, we want to reduce it to try and encourage investment. And if the economy is going too quickly and inflation fears are creeping in, they'll lift interest rates to slow down activity. The blue line is bond rates, and that's effectively what the bond market is expecting to happen in cash rates on average for the next 10 years. That's a 10-year government bond rate. And so what the market is effectively saying here is, notwithstanding cash rates are really low right now, they do expect them to pick up over the next 10 years, and they're expecting to get up to sort of 1.5%, 2%, maybe even 3%. So quite a substantial increase. But even then, once we get there, it's much lower than what we've seen in the past. In terms of our expectations, we expect cash rates to travel on in the longer term in this blue band, somewhere between a little bit less than 1 and maybe a little bit above 2. And clearly, while that's a lot lower than effectively zero at the moment, a lot higher than the zero at the moment, it's a lot lower than what we've used to in the past. So the really clear message from us is, we have no expectation of going back to the old days. I won't say whether they're good or bad, where interest rates were typically 3, 4, 5, 6, or 7. We think they're going to be stuck in this 1 to 2% range for a very long time. And the main reason for that is there is so much debt, both government debt, but more importantly, household debt, which is basically home loan borrowing, that if interest rates go up too much, it'll basically put the economy into a recession, and very, very quickly. And so I would expect that at 3% cash rates, we would be in a recession. So because the central bank, being the Reserve Bank, don't want us to be in a recession, they want us to slow down perhaps from time to time, it's, I think, unlikely they're going to go much beyond 2%. They could get to 3%, but that's going to be the limit, and then they come back again. So this idea that cash rates stay low for a long time, of these two rates, which ones are important to us? Well, it depends on what you're interested in. The cash rate is the one that sets home loan rates. So home loan rates won't pick up until cash rates pick up. They probably will pick up 1.5% over the next few years. So the very low home loan rates we're seeing at the moment probably won't last, but they're not going back to the old days or anything remotely like it. On your cash management trust, clearly that's the cash rates. And also TD rates tend to be dominated by the low cash rates. Looking at the major banks, the rates I was looking at the other day, as good as you could get for 5 years on TDs was 0.25%. So clearly we're going to be looking for options other than that. In terms of the bond rate, that's more important for the returns you'll get out of bond funds. It also has big implications for equity and properties. So for example, if bond rates were at 5% and you went to buy an office building, you'd probably want to get a yield on it of at least 8%. Today, with bond rates 1 to 2, yields on office buildings are about 3 or 4. So you get lower returns when interest rates are lower, right across the board. It's not just the bond rates, it's also properties. Now, the thing is, you say, well, should I like getting a yield of 4% on office? Well, if you've bought it on a yield of 8, you do like it a lot, because the way typically you get that yield from 8 down to 4 is not rents falling, it's the price increasing. So you kind of like it when yields fall if you're an existing owner, and you don't like it if yields go up. So this idea of interest rates going up much would be a big negative for equities and property. We don't think that's going to happen, which is one of the reasons we're comfortable. The question people always ask at this point, and it's a good question, is what about inflation? And if you haven't heard much about it yet, you're going to hear more and more about this in the next 6 months. And there's a whole bunch of drivers here. The first one is in the United States last month, we got a very high inflation number, the highest one they've had in years. And many commentators saying, well, this is the shape of things to come. There's been talk for some time about all the money printing going on by governments. There's huge budget deficits. We saw that in our own budget. We're seeing it everywhere. And then there's this idea that's been floating around that the governments are going to inflate away the debt and they really want high inflation. All of this you'll hear more and more about it, and it is a legitimate cause of concern. Sorry. One of the questions often then flows, so why do we worry about inflation anyway? Typically, the reason we worry about it is, as we mentioned earlier on, when you get high inflation, that's when the Reserve Bank lifts interest rates, lifts cash rates to try and slow things down. So when you get high inflation and higher interest rates, typically your bond prices fall. So if you're invested in bond funds, those prices fall. Equity prices typically fall. Commercial property prices fall. Residential property prices fall. You can imagine, the impact on residential property prices if instead of paying 2% on your home loan, suddenly you're having to pay 7 or 8. So we really ought to worry about inflation. So back to the things you're going to be hearing about. The only one that's actually new here really is this huge budget deficits. The recent large CPI number in the States is a response to everything that's happened around COVID. I think it's a short term, maybe not a one-off, but I think that is transitory. I don't think that will last. The factors there are shortages for certain goods, a huge amount of spending as people come back out of lockdown into the economy. I think that's kind of one-off. The other ones, the money printing, the idea that government's going to inflate away the deficit, they've been around for years, and those thoughts have not resulted in any significant inflation pretty much anywhere. The one that is different is the huge budget deficits, which is obviously back to our budget. We've seen it here. And the question is this a big deal? Right now, I think not. And the guidelines we're using, the one we think about a lot is Japan. Japan, over the past 20 years, have taken their total government debt from about 70% of their GDP, the size of their economy, to 2.5 times the size of the economy. Ours is still about 50%. Japan have done that and have run huge deficits all along the way without creating any inflation there at all. So ultimately, big deficits are inflationary. The really interesting question is just how inflationary. And the answer from Japan appears to be it's got to be a lot more than we're doing now before it's going to have too much of an inflation impact. So in the past, we would have looked at a deficit the size we've got at the moment, 10% of GDP, 15, and say, that's terrible, that's going to be inflationary. It doesn't seem to be the case. So this is obviously a place we're going to be watching carefully, but for now, we feel that the spending that is happening is actually a good thing for the economy. Ultimately, they're going to have to scale it back. But in the meantime, in terms of inflation, in terms of interest rates, not too much to worry about. So that's our second point, that in the long term, we're expecting cash rates and bond rates to stay pretty low, certainly much lower than we've seen in the past. The third point then is growth returns should be higher than term deposits, which is not that difficult when you've got very low interest rates. The process we use to help us make asset allocation decisions is we prepare 10-year forecasts for the different asset classes. We feel it's much easier to make a long-term forecast than a short-term forecast. Last year was a fabulous example of that. And what we then do is, looking through the forecast for the different asset classes, if they appear too low compared to what we're getting out of TDs, we'll start reducing weights. Now, you might say, look, for the last 10 years, we've done precious little of this. And the reason is pretty simple. For the last 10 years, the expected returns out of equities and property have been well and truly in excess of what we expected to get out of TDs and bonds. And that's the way it's played out. And the right thing to do has been pretty much fully invested, which is where we've been. So, but we're continually monitoring this one. And the margins are now getting a bit smaller. The way we do our forecasts is we basically think of income and growth. For the income side, it's your dividends or your yield on your property. And then for the growth part, if you think about a company, let's say it's earning $1 million a year, the market at the moment is paying about $22 for every dollar of profit. So if you've got a company earning $1 million a year, it's probably valued on the share market at about $22 million. The way to get your price up is to either get your earnings up or how much the market's prepared to pay for you. So one of the things you're looking at is, well, how fast the company's going to grow earnings. And the second one is to say, if the market gets all excited, instead of paying $22 for earnings, it pays $42 for a dollar of earnings, you're going to get a lot more growth. Similarly, instead of paying $22 for a dollar of earnings, you're down to $10, the market's going to fall. So it's a sentiment factor is important. The way it looks at the moment for Australian equities, we've got income of about 4.8. That includes the franking credits. In terms of earnings growth, we think companies on average in Australia will grow their earnings at about 2.5% a year. And all things being equal, that should result in 2.5% a year of growth in the share prices. But right now, the market's paying this $22 for every dollar of earnings. That is historically high. For where interest rates are at the moment, I think a more reasonable multiple is about $17. So if we find that for every dollar of earnings, instead of paying 22, we're paying 17, that implies prices grow 25% slower than they otherwise would. Spread out over 10 years, that takes 2.4% per annum off our earnings growth and our share price growth, and we end up with a 5% total return. And you look at, say, 5% from equities, it's not that flash, and it isn't that flash, but it's still reasonable compared to TDs. In terms of the way this process works, some of you would have sat in our November briefing. In November, our 10-year forecast for equities, Australian equities, was 6% per annum. What's happened between now or November now is share prices have gone up by about 10%. So instead of getting this steady 6% per annum return, we've got it all in a rush. And effectively what's happened, it's taken 10% of returns from the next 10 years and brought them all into the last 6 months. And so our forecast return falls by about 1/10 of that 10%, from 6% down to 5%. And the faster equities go up, the lower we should expect our future returns. But the nice flip side of that is if equities fall, which we don't want to happen, future returns should go up. Now, so we go do this across all markets, and basically everywhere you turn, returns are fairly modest. They're 4s, 5s, 6s. And on one hand, you say, well, that's a lot lower than we're getting in the past. On the other hand, you compare it to what we're getting out of term deposits or government bonds at about 1.8 or so, it's still better. And that is really the key thing. As long as we're getting better returns or expected returns out of equities and property, we don't want to be shuffling money away from growth assets into very secure assets like government bonds. So that is the third major point, this idea that we're going to get better returns out of growth assets than we are out of bonds. The exception is United States. Let me quickly describe this table. If we start off with the little red triangles are where markets are at the moment. And so if you look at the Australian equities, the first column on the left, it says at the current market price, we're expecting to get about a 5% return. I describe that as fair value. If share prices go up and say it went up to 9,000 for the All Ordinaries Index, our forecast return would be now down to 2 because our yield would be a whole lot lower. And it would mean instead of paying 22 times for earnings, we're probably paying closer to 30 times. And so in other words, prices are too high, future returns will be low. The colours, basically in the red is where we're expecting lower returns than we're getting out of government bonds. The yellow, we're getting somewhere between government bonds and 2.5% above. I call that fully priced. You're getting a return for the extra risk you're taking, but it's not as much as you'd hope to get, not as much as you've historically got. 2.5 to 5 in fair value. And typically, equities and property in the long term have given about 5% better than bonds. If we're getting better than that, we call it cheap and we're in the green zone. So you see now the world equities outside the United States, REITs, Australian equities, all around fair value. In the United States, it's really pushed up heavily into that overpriced area, and we're starting to reduce there. Now, one of the questions you might have is, why have we got any money there at all? Typically, the way this works is this forecasting process works well over 10 years. It tells us very little about 1, 2, 3, and 4 years. And what you find is when you push up into that red zone, it often keeps going for a number of years. And so pulling out all of your money from those areas straight away tends not to be a great strategy. So what we do is reduce slowly over time. Typically it might be 1, 2, even 3 years before as we sell down these assets slowly. So don't expect dramatic moves in your portfolios, but we'll certainly be heading in that direction. So that's the next one. Is basically the US is the one market where we really have a concern about. Other markets are at fair value. The final point, we think credit is pretty good value. By credit, we mean basically fixed interest type investments where it's not government guaranteed. Your term deposits are government guaranteed, your government bonds are government guaranteed, basically everything else isn't. If you've got bank hybrids, those are not guaranteed by the government and you get a higher return on them. If you bought a bond that was issued by BHP, that would be a higher return but not guaranteed. But doesn't say it's not a great investment. It probably is a good investment because you're getting that higher return. If you go right out on the credit spectrum where you're investing in riskier companies, the returns you're getting are reasonably attractive. They're about the same as you're going to get for equities, but we think they're lower risk than growth assets, equities, and property. So that's makes it a pretty interesting investment right now. Getting into the jargon, you're probably aware that cash and term deposits, which are there to finance day-to-day spending, we refer to as bucket 1. The growth assets, equities and property, infrastructure, we refer to as bucket 3. Bucket 2 is everything else. It's typically fixed interest type securities that have more risk attached to them than your government guaranteed securities. Most of you would have used hybrids extensively, and they've got some volatility attached to them, but by and large have produced very good returns. We think they've got extremely low chance of not getting your money back at the end, so we particularly like those. The second one are triple B bonds, excuse the jargon. They are called investment grade. They are ones where the rating agencies have a high degree of confidence that they will repay on time, but not total confidence. They tend to pay about 1% more than government bonds, and occasionally they fail. And the failure rates on average for diversified portfolios of investment grade bonds work out at about 0.2% per annum. So you're being paid 1% to get on average a loss of 0.2, which we think makes them pretty good value, but they are volatile. Then we move down a step to high yield debt, normally called sub-investment grade, sometimes junk bonds. They tend to pay 3 to 4% better than government bonds. They've got higher failure rates than triple B and higher volatility. They're the ones we think are very interesting right now. The other one, which is new, we're having a look at, is very long-term government bonds, which pay much better returns than cash and are also quite volatile, but have got what we describe as good volatility, and they tend to go up when equity markets are weak, and they will tend to fall in price when equity markets are strong. So they tend to smooth out your overall portfolio. If you look at them in isolation, you might say, look, I'd never touch one of those. In a portfolio, they work quite well. What sort of volatility am I talking about? This is an index of US triple B securities. It's the average across a whole range of them. In March last year, and this is just a couple of years of data, they fell about 16%. They very quickly bounced back. Sometimes it takes longer than that. And right now, over the last couple of years, they've done quite well. This is really not unusual seeing this. So yes, they are volatile, but if you take a longer term view, they tend to bounce back. The next one are the high yielding securities, which is a more risk again. Those ones fell even further. They were down 20% last March and have bounced back. And now, with the benefit of a couple of years, they've given you about the same returns as the triple Bs or the investment grade securities over that period. For contrast, I'll throw in government bonds, and this would be a typical government bond fund, for example. On average, the bonds in the fund will have a maturity of about 5 to 7 years, and they're not nearly as volatile as are those non-guaranteed securities, the investment grade or the non-investment grade securities, but they still have some volatility. You look at right down there on the right-hand side, in the first part of this year, those bonds fell about 5% because interest rates went up. So, if you've locked in a 5-year bond, which has got an interest rate of 1, and all of a sudden now everyone else is getting 2 on new bonds, well, guess what? They're going to take 1% off your price for every year that you've got the bond, and now it's down about 5%. And that's the way the bond markets work. When bond rates go up, your price of your bonds fall. But a really interesting one, and for contrast, is another government bond. It's the GSB 2047. It's a government bond, and it matures in 2047. So it's got 26 years of life to it. So if interest rates go up 1% here, they're going to be penalising you for 26% times. And so it's much more volatile. If you look in the first half of the chart, you see at the time where other bonds were going down, it went up a lot, which made it a really good diversifier. It was up about 15%. Then as the crisis started to wane, the price came back down again, and then it went sideways. And in these recent times, where bond rates have picked up 1%, they've fallen by 18%. So they can be volatile. That 18% fall occurred at a time when equity markets were going up a lot. So it tends to smooth out your portfolio. We think we certainly weren't interested in these ones a year ago. Today, we're really having a close look at them. If you look at the kind of returns we're expecting to get, and this is over, say, a 5-year period, if you're investing in TDs or cash, we think you might get up to 1% per annum. That's assuming the Reserve Bank lifts interest rates a little bit. We think government bonds might give you 1.3, and I'm thinking your typical government bonds where you're investing in about 5-year to 7-year type bonds on average in a bond fund. If you bought into a fund which concentrates on investment grade credit, you might get 2% a year. high yield about 4.5%, and these 30-year government bonds are currently yielding about 2.6%. You're buying them, as it would suggest in this chart, about 85 cents in the dollar. They will repay in a long time at 100 cents in the dollar, but they're a really interesting one, and yielding 2.6%, it's better than you're getting from your credit, your investment grade credit. Not as good as your high yield, but just a really interesting one that we're having a close look at the moment. In terms of the high yield side of it, the idea of the risk, there's two ways of thinking about risk. One is that short-term volatility we saw early on. We think a much better way is to thinking more in terms of a medium term. So over 5 years, what does it do? And if you look down that column, we've gone back since 1980 and said, what was the worst year we had for each of those three types of securities? Then what was the second worst year, worst 5-year period we had, then the second worst 5-year and the third worst. And looking at that worst and the second worst, for investment grade securities, we got positive real returns after inflation, even in the worst periods. When we got to the high yield though, there were some reasonably significant losses. You were down 15%, 11%. But if you compare it to equities, which is the right-hand column, over 5 years, you can still be down 26%. That's why I say, look, there is actual risk attached to these, but it's lower risk than you're getting in equities. And while we're getting about the same sort of returns, it's a pretty interesting place for us to be looking. One of the things we're looking at is non-bank lenders. As you probably know, after the global financial crisis, the regulators have really tightened up on bank lending, and they've moved out of a lot of lending activities, particularly to small and medium-sized companies, and lending on property, commercial property, and some residential property that they used to do. There are other lenders who have come into this space. Typically, they make a loan with a property or some sort of hard asset as security. The returns, you tend to get 5 to 6% on these. Clearly more risky than traditional fixed interest like government bonds and TDs, but they're less risky than shares. And that's one we're looking very closely at the moment. We've not made clear decisions around this, but it's an area that we're certainly having a really close look at. So the 5 key themes today. 1, we think the COVID recession will have major impacts on society, but not a lot of an impact in terms of long-term returns. Interest rates likely to stay low for decades. Shares and commercial property will give us better than these low interest rates we're getting out of TDs and bonds. The only market we have real concerns about are US equities. Other markets are fair. And we think credit's good value compared to equities, and it's an area of a lot of focus for the investment committee right now. So thanks, Graeme. If you have any questions, I think probably we've got a little bit of time now.
Hey, thanks, Tim. I'll just turn my camera on as well. I've just got the chat field. We do have a question, which I reckon is best placed for you, from Stephen McCusker. So thank you, Stephen, for asking the question. So his question was, although I know you've said in the presentation that we are probably not in the camp that we believe inflation is going to take off, but if it did, what would be some strategies to counteract that you could take in your portfolio? In particular, any hedges you think that might work to protect against inflation being higher than we think? Okay.
One of the things you'd want to do is there's 2 bits to that question. One is to say, what time frame are we thinking about? And this is where it gets quite difficult. If you're thinking about a 3-year time horizon, it's very different from a 10-year time horizon. Over a 3-year time horizon, if inflation became quite persistent, then one of the likely responses is the Reserve Bank will lift interest rates sharply. That will cause bond prices to fall sharply. It will cause equities to fall sharply. It will create a recession. So if you thought that was the most likely course of action, you would be out of equities, out of property, out of bonds, and loading up on cash, which is giving you 0. The cash will pick up in returns as the central bank lifts them to sort of 2 or 3%. If you're wrong and it doesn't happen, then you're going to get really bad returns for a very long time. So it's almost like a binary one. just about everything will perform poorly in this environment, with the possible exception of gold. And you say, well, is gold a good place to put your money then? And the answer is maybe. But one of the issues with gold is it's, and has been for thousands of years, a store of value. And when you dig into it, what that means is it goes up on average at the same rate as inflation, which basically means it should be performing at 1 or 2% a year, which is not much different from cash. But right now, in real terms, it's very close to an all-time high. It's been at this level, from what I can tell, twice before. No, 3 times before. Once was in a couple of years ago, then it was in 1980 before it fell 80%. And the other time was in about 1300. And then it fell another 80%. And that fall took, I think, about 300 years to reverse itself. So gold is one where you say, look, maybe, but if it doesn't work out, the returns are potentially very poor. And for it to save you in the event that we did get a big burst of inflation, you'd have to have a lot of money invested in that. If you put 2 or 3% in, it really doesn't make much of an impact. So my sense of it is, if you're worried about a 1 to 2, 3 year period, there is nowhere much to hide other than making a big call. And I would certainly not have the confidence to make that call. Over a 10-year period, it's a very different story, which is the time horizon we look at. Over a 10-year period, I'm pretty confident that a reserve bank will lift interest rates to the extent that they need to crush inflation. Now, whether that puts us into a recession or just slows us down, I don't know. And I'm confident that they will do that inside of 6 or 7 years, which means over our 10-year time horizon, we've had a recession and things are back to normal, and we've had the kind of returns that I put up, and we will have done better by being equities than in cash and fixed interest. So taking that longer term time horizon, I think, gives you the confidence. You say, well, can we risk a major downturn in the middle? Well, we take that risk every day. The big thing about markets is the thing that upsets them the most is the thing that no one predicted. And, how do you predict something that's inherently unpredictable? And so COVID was just a great example. It came out of nowhere, and all of a sudden the markets are down 30 or 40%. It turned out to be very brief, but, can you manage your portfolios with a permanent fear of something like COVID around the corner? Well, you'd be in cash the whole time. And so the correct answer is to take a portfolio with the right amount of risk for your own personal circumstances and take a long-term view. Adjust your views constantly. If inflation really looks like it's setting and it's going to become permanent, there are a whole bunch of things we're going to be doing in portfolios. And the first and foremost will be putting much more money in cash than fixed interest. It just doesn't look like that's a likely outcome at the moment. And the implications for getting that one wrong are huge. Yep. And so you just go with the evidence and say, look, it's far more likely low interest rates, low inflation over the longer term, and invest accordingly. If those probabilities change, you'd have to make a change.
And it's probably fair to say that is one scenario where most assets will suffer, but if you've structured your cash flow and buckets properly, you should do far better than somebody who hasn't. So Therefore you could still have the dividends would likely continue at a reasonable level. You would still be able to pay pensions, things like that. And it's just probably a case of affording yourself some time for that to play out and asset prices to recover.
And in that bucket one with the cash and fixtures, the returns coming out of that would actually be going up.
So thank you for that. That was a good question, Stephen. So we're open to any questions. So there's no other questions in the chat field, but we're open to questions from the field. If anyone wanted to unmute and have a go at asking a question. Is that Andrew wanting to ask a question?
Yeah, g'day. How you going, Graeme? I deal with David. He's been excellent. And I put a question to him at our last meeting. Would it be wise to borrow money against the house. In other words, take out a mortgage on a property I already own to put into my super fund.
Whatever David said is right.
He said it was right.
So we might refer you back to the disclaimer, which was about slide 2 there. And that was yeah. Look, that is right. I mean, at the end of the day, everyone's in a different personal circumstance. There's good debt, there's bad debt, there's tax deductible debt and non-tax deductible debt. You have to, without taking on any debt like that for investment purposes, you probably want to be doing it for the longer term rather than the shorter term. But I'm sure, as for anything more than just a sort of broad brush statement like that, I would be deferring to David for personalised advice on that one.
Well, look, and you know that I have. I guess it's just that I've listened to all of this today, and I've seen these returns are pretty low.
Yeah.
I'm sort of starting to think, is this even worthwhile? I'm not sure.
Well, what's your alternative is the big question.
That's the differential. Yeah.
And it's kind of the interesting one on just gearing strategies in general is, I think the returns can be high enough, but is an extra 3% enough to make it worthwhile? And I think the answer is probably, if I'm having to pay 4% on my debt, well, the answer is probably no. So it does depend on lots of things and how much you're paying. What type of investments can you find? And there may be ones that are more attractive than these broad markets. But generally speaking, the margins are a bit skinny. As a generic, I wouldn't be wrapped in the idea of taking on a lot of geared investments at this stage.
Yeah. So the general theory is you borrow at X%, but that's generally fairly certain what you're going to pay, versus you invest at Y%, which is probably uncertain. So there's a bit of certainty that you lack when you reallocate those money, but you obviously do it for the purpose you think you're going to get a better return than what you're borrowing for. But then you've got to look at the after-tax return as well. So if you might invest in super where you get a tax-free rate of return versus but then if you've borrowed to invest in super, you're probably going to get a tax deduction on the debt that you borrowed. So you won't. So these are the types of discussions you need to have with David, which I'm sure you have. So
good on you. Thanks.
Now, any other questions from the field? Doesn't look like it. Look, so if that's the case, then we're now at sort of 2 minutes past 12. So we're up for time. If there is any sort of questions that hit you later on, please feel free to email our inquiries email. Katie, I think we have that there somewhere.
Yes, it's events@firstfinancial.com.au.
Yep. So any questions that you'd like to ask afterwards, email to that. But otherwise, I'd like to thank Tim for his contribution and participation today, and also everybody else for their patronage and participation. It was very good, and I hope you found some value in it. But yeah, certainly any questions you have, go to your advisor at First Financial, because they're aware of all this as well, and they'll be able to personalise it for your particular situation. So thank you for your time, everybody.
Thank you.